Why does price move before the news? Have you ever seen this happen? A major economic announcement is scheduled for 10 a.m., but at 9:45, price suddenly starts moving. The market jumps. Traders start buying or selling. Then, at 10 a.m., the actual news is released, and sometimes, price moves in the opposite direction from what you expected. So here's the big question. How can price move before the news is even released? Does the market know something you don't? Not exactly. The answer is much more interesting. Chapter 1. The market is always anticipating. This video is for educational and informational purposes only. It is not financial advice. Trading involves risk, and past performance does not guarantee future results. The first thing to understand is this. Markets don't simply react to news. Markets react to expectations about news. Imagine economists expect an interest rate decision to come in at 5%. Traders don't wait until the announcement to think about it. They are already positioning themselves before the announcement. If most traders expect the same outcome, that expectation can already be reflected in the price.
So when the actual announcement arrives, the important question isn't simply, was the news good or bad? The important question is, was the news better or worse than the market expected? That's a huge difference. Chapter 2. Expectations move price. Let's use a simple example. Imagine a company is expected to report $1 billion in quarterly profit. Traders become optimistic. They buy the stock before the earnings announcement. The price rises. Then the company announces $1.1 billion in profit. That sounds great, but the stock suddenly falls. Why? Because the market was already expecting strong results. The actual number was better than expected, but perhaps not good enough compared with what traders had already priced in. This is one reason you can see price moving before major news. The market is constantly trying to predict the future. Chapter 3. Large traders don't wait for headlines. Another important concept is positioning. Large financial institutions, funds, banks, and other market participants may adjust their positions before major events. They don't necessarily know the exact result. Instead, they analyze economic data, analyst forecasts, previous reports, market expectations, central bank communication,
and many other factors. They build scenarios. For example, if inflation comes in higher than expected, what might happen? If it's lower, what might happen? They prepare before the announcement. And when many market participants adjust their positions at the same time, price can begin moving.
And many other factors. They build scenarios. For example, if inflation comes in higher than expected, what might happen? If it's lower, what might happen? They prepare before the announcement. And when many market participants adjust their positions at the same time, price can begin moving. Chapter 4. Why price can move before everyone else knows. This can make the market look like it has a secret, but often the explanation is simpler. Information doesn't always arrive in one giant moment. Markets continuously process information. Economic reports are published over time. Central bank officials make comments. Analysts change forecasts. Companies provide guidance. Other related markets move. All of these pieces can change expectations. So instead of thinking, the news came out and price moved, think, expectations changed and price adjusted. The official announcement may simply be the final piece of information. Chapter 5. Good news can make price fall. Here's one of the most confusing things for beginners. Sometimes good news causes price to fall, and bad news causes price to rise. That sounds impossible. But remember, price reacts to expectations. Imagine traders expect extremely positive news.
Price rises for several days before the announcement. Then the announcement arrives. The news is positive, but slightly less positive than expected. Traders who bought earlier may start taking profits. Other traders may sell,
price falls. This is sometimes described as buy the rumor, sell the news. It doesn't happen every time, but it's an important market concept. Chapter 6: Why Beginners Get Trapped. This is where things become dangerous for new traders. A beginner sees an upcoming announcement. They think good news means price will go up, so they enter a trade. But experienced market participants may already have positioned themselves. Then the announcement arrives. Price suddenly moves in the opposite direction. The beginner thinks, what just happened? The answer is that the market isn't simply reacting to whether the news is good or bad. It's comparing the result with expectations. That's why trading major news events can be extremely difficult. Chapter 7: The market can become extremely volatile. Major announcements can cause rapid price movements. Candles can become much larger. Spreads can change. Liquidity can become more difficult. Price can move sharply in both directions.
For beginners, this can create the temptation to enter quickly. But fast movement doesn't automatically mean opportunity. Sometimes the smartest decision is simply to watch. You don't have to trade every news event. Learning to stay out of dangerous situations is part of becoming a disciplined trader. Chapter 8: What Beginners Should Watch. If you're learning to trade around news, start with observation. Look at an economic calendar. Find a major announcement. Before the release, record. What does the market expect? What happened previously? What has price already been doing? Then watch what happens before and after the announcement. Don't worry about making money. Focus on understanding the behavior. You can even practice this using a demo or paper trading environment. Your goal is to build knowledge before putting significant capital at risk. Chapter 9: The Big Lesson. So why does price move before the news? Because markets are forward-looking. Traders are constantly making predictions. Expectations influence positioning. Positioning influences price. And when new information arrives, traders adjust those expectations again. That's why the headline itself isn't always enough to explain the market reaction. You need to understand what the market already expected. Conclusion.
The next time you see price moving before a major announcement, don't immediately think, someone knows the news. Instead, ask, what is the market expecting? That question will take you much further. Markets aren't waiting for the future. They're constantly trying to price the future today. And that's one of the most fascinating things about trading. Remember, price doesn't simply react to news. Price reacts to expectations, positioning, and new information. If you're a beginner, don't rush to trade major announcements. Study them, observe them, paper trade them, and learn how the market behaves before risking real money.